Good afternoon, everyone, and good morning to our West Coast participants. Thank you for joining today's ICD webinar, Executive Compensation Trends, Key Learnings from the 2021 Proxy Season. My name is Scott Munn. I'm a partner with Hugessen Consulting, and I'll be moderating today's session along with my colleague, George Soiree. Before I begin, on behalf of the ICD and Hugessen, we honor and acknowledge the traditional territories of the people of the Treaty of Seven region in Southern Alberta, which includes the Blackfoot Confederacy, the Tsuut'ina First Nation, and the Stoney Nakoda. The city of Calgary is home to the Métis Nation of Alberta Region 3. I'm based in Calgary, and my colleague George is based in Toronto. I also recognize the enduring presence of the Indigenous peoples on this land, and that our attendees today are located all across our country and on other Indigenous lands with applicable treaties and unceded territories. Today's webinar will run for 1 hour and includes a 10 to 15 minute section for Q&A towards the end. Please send in your questions by using the Q&A icon at the bottom of your screen. At this time, all of you are in listen-only mode. We will be advancing the slides. The event will be recorded and saved to the ICD website within about 24 hours. And if you have any technical assistance needs, please contact Kim Carthy. Her contact information will be put into the chat. So let's begin. Before we get on to the agenda, let's talk a bit about the context for today's webinar. 2020 was a historic year of both highs and lows. Some sectors suffered significant declines, hospitality, energy, travel. Some sectors saw significant gains or benefits because of COVID-19 and the way in which that rippled through our economy. In the midst of the COVID-related crisis, we saw a disruption that actually spurred the tech sector, for example. So today, we're not going to actually focus on salary rollbacks and the short-term pay decisions of 2020, but rather on the enduring trends and the long-term pay implications that we expect to come out of this current economic environment. So with that backdrop, let's take a look at the agenda. We're going to start with key executive pay trends that we noticed in our review of the proxies this year. We're going to look at changes in the stock option taxation. We're going to talk about ESG, DE&I, and other hot topics that fit into committee conversations right now. And lastly, we're going to have the Q&A section. So if you have any questions or comments, please send them to us in the Q&A. Let me introduce our panel. I'm joined today with Jennifer Mackey. So Jennifer is a board member at Baytex and Franco-Nevada and Pan American Silver. She had been the compensation committee chair at Baytex. She's also a former executive and was CEO at Ballet Canada. Tim Penner is the current compensation committee chair at Intact and Jameson. He also serves on the board for the Hospital for Sick Children's and is the former president of Procter & Gamble Canada. George and I are with Hugessen Consulting, based in Toronto and Calgary, respectively. We advise boards on executive compensation, corporate performance measurement, related governance, as well as board effectiveness. We work with clients in Canada and the US. And frankly, we've been working with the ICD for a very long time. We're very pleased to support them in today's webinar and in the director education program across the country. From the ICD, we're joined today with Laurie Brotherton and Salam Tessike. So a lot of intro and background. George, I now pass it over to you.
Thank you, Scott. And when I look at that picture of me, people will now see the live version. They'll know I got my homemade haircut. So you'll have to stay tuned a year from now for a much more stylish version, I'm sure. Anyway, so we are going to do a few minutes here on the year in review, and I'm going to turn to the first slide, which sets the context for what happened in the stock market. And picking up on the cues that Scott mentioned a moment ago, clearly there was massive disruption that started at the end of calendar Q1. It was reflected in the stock market meltdown at the time. But we quickly saw strong resurgence through the course of the year. Now, this picture does show that the resurgence was uneven through the economy, different parts of the economy, with the energy sector not coming back to where it was before. It's still below at the calendar year end. and material sector, for example, ended up a little above. So it is a story of several tales. It's not just a homogeneous story. And as we get into some of the pay data, you'll see the same story matches. So with that, let's turn to the next slide, where we look at actual pay data. For those who've been listening in on these in prior sessions, you'll recognize this picture. So what is the key takeaway? This is basically saying that for the CEOs of the TSX 60 in 2020, the awarded pay was essentially flat year over year. So whether it's the same 25 CEOs who had the same role year over year, or the same companies, they may have changed CEOs, the fact is compensation was flat. And when we look at compensation, this is all elements of compensation added up together: salary, short-term, long-term, and other. If you add it all up, compensation was flat. And the 5-year trend for the same incumbents is about 5%. So this is a bit puzzling. I would have thought that after what was still a tough year across the economy generally, and we know that operating results, even if stock market has come back, I would have thought there'd be some decline. So this is a bit surprising. But if we go to the next page, you'll see that if you look by sector, that in fact you do see a divergence of awarded pay. So those that had somewhat of an uptick and had some tailwind will be some companies in the financials. Those who actually had a decline in total pay would be on the left side, they'd be in the energy companies. So how is that possible? Why is it only these kind of changes? Well, we know that there were salary rollbacks for certain sectors. So that would have taken pay down year over year. And especially short-term incentives, they would have been down, but not across the board. But the biggest part of dollars for the TSX 60, we know, are LTIP awards. Now, most of these LTIP awards were actually awarded before the crisis hit. Most of these were granted either in late calendar 19 or early calendar 2020, January or February. That's a fixed number. These are the reported numbers in the circulars. And so that's why those numbers are high, because they don't decline with the stock market in terms of reported value in the circulars. We'll talk in a bit about what the realizable scenario might have been. So with that, I'm going to turn it over to Jennifer and Tim to share how they dealt with size of pay in what was a tumultuous year.
Maybe I can start and just say that the trends that you're talking about, George, even by sector, are still averages. And so individual company results will differ. If I take Intact as an example, it has grown very quickly over the last 5 years through acquisition and also through organic growth. And so our compensation philosophy has stayed the same, and our approach has stayed the same over that time period. We compare ourselves to similar sized organizations, but we've had to change that comparator group multiple times over the last 5 years because we've been growing so much more quickly than some of the other companies in that comparison set. So larger companies pay larger salaries, and it's not linear, of course. If you double the market cap of your company, you don't double the CEO's pay, but there is a positive correlation between size of company and CEO compensation. And so because we've grown so quickly, CEO comp and executive comp in general has grown much more quickly than the averages that you're talking about at Intact.
In the energy sector, as it was one of the sectors hit hard in 2020, I can say the discussions on comp started earlier and lasted longer. We had a period of salary rollbacks for employees in the board from April into December. And certainly at points in the year where the company's equity was hit particularly hard, we did review the peer group to determine if we had it right. And ultimately, we concluded that it was right. And this has been reinforced by significant improvements in the company's equity since then.
You mentioned the impact of the change in price of shares through the course of the year. What was evident that the roller coaster ride through March, April, May, and then extended into the fall as the movie unfolded. but the real impact on all employees and executives who receive equity awards was dramatic for most companies, right? With what we call the realizable value, like if you mark to market what these grants were worth, they were in steep decline and quite dramatic, especially for those companies that have highly leveraged programs, with the value of these awards going down a lot in end of Q1, some starting to come back. But for many companies, the value of realizable pay was still well down below the grant values, even though the reported value, is relatively high. Now, for some others that rebounded strongly, they're enjoying a lift. And so the boards that were watching this movie unfold and debating, what do we do about LTIPs? It was very hard to figure out what to do. And so many companies, in fact, waited till the end of the year to see if we're going to make any adjustments. We better wait to see how this, flushes out by the end of the calendar year. And that's why, most companies did not make quick changes to LTIP or anything like that in the middle of 2020. So maybe let's now go and do a deeper dive on the structure of the short-term incentive programs amongst the TSX 60. So on this picture that's coming up, we're showing the average scorecards for the TSX 60, and the big takeaway on the structure of these cards is that they didn't change that much. The number of metrics stayed about the same. The proportion of metrics that are tied to financial results stayed about the same. If you're very keen on looking at the math, you'll see that the ESG component went up by 33% in weight from 6 to 8. So it's a big percentage increase, but it remains a small fraction overall. And we'll be doing a deeper dive on ESG in a few minutes. So not much structural change. However, the one statistic that does jump out is that almost half of the TSX 60 companies disclosed that their boards exercise some kind of discretion in either scoring the year-end results or having adjusted potentially some of the performance indicators. Now, that's not a complete shock. We knew during 2020 that many companies were likely going to use discretion, but as it turned out, that was the case. So again, turning to perhaps Jennifer first, and then Tim, you can share stories of how the formulas worked for you and how you may have or did not have to use discretion.
Thanks, George. In terms of the use of discretion at Baytex, no performance metrics were changed, despite the significant challenges in the energy market. The scorecard design has 20% allocated to a few key projects, which the board aligns on at the beginning of the year, and those are scored on a discretionary basis. We did change the projects we scored as a result of the changes in the macro environment, but without changing the financial metrics, as we didn't, a lot of them ended up being zero. Of course, one of the concerns we have for that is retention risk and ensuring that the company remains competitive. In energy, we've had 4 down years. And so as you spoke about earlier, George, the realized versus awarded comp has been significantly lower. As I said earlier, our discussions took longer, and we also did make the decision to move the stock award date out. So it would align with the release of our results, but that gave us the added benefit of time and allowed our stock price to recover, which helped us with the dilution, which was one of the key topics we talked about during the process.
Right, one of the most sensitive for many companies with their stocks in decline. They trying to issue a bunch of equity at very, very low prices just didn't make sense. You had to be creative.
Yes. And
Tim, how about your experience?
Well, we did not choose to exercise discretion at either Hugessen or at Intact. At Hugessen, I mean, they had an excellent year. Consumers are very, as you might expect, very concerned about their health. And so the market for vitamins, minerals, and supplements has been very strong. And then in addition to that, across consumer goods, there has been a general migration to quality. Hugessen is a highly trusted brand, and so we've grown our market share quite significantly over the past year. At Intact, COVID affected various metrics leading to sort of mixed results. the company offered rebates to our policyholders, and that affected top line growth. We also have a large, in the US, a large entertainment insurance business. And when rock concerts got canceled a year ago, we paid a lot of claims. On the positive side, we insure a lot of automobiles, and when people drive less, they have fewer accidents. And so that has helped with car insurance claims. So it's been sort of mixed, some pluses and some minuses, but in the end, we allowed chips to fall and said we would not exercise discretion at either company.
Interesting, quite a divergent set of circumstances, and accordingly different reactions needed by companies and the boards in light of those. And by the way, a reminder to the audience to craft some questions or areas of topics that you'd be interested in us covering later on in the Q&A. There's the Q&A function down below. Please do enter those, and then we'll try to get to some a bit later on. So let's now move to what happened to the LTIP, long-term incentive structures, amongst the TSX 60 last year. No earth-shattering shifts. There was a modest but noticeable reduction in the use of options overall from 29 to 26% on a weighted basis. It had been pretty steady at around 30%. So now you're seeing a noticeable change. And we'll talk about the taxation issues in a few minutes. But basically, PSUs continue to be, no surprise, a very significant part of the LTIP mix, pretty steady, just north of 50%. And relative TSR continues to be a pretty common metric, although other metrics are finding their way into the PSUs to create some kind of balance to reflect true holistic performance for companies. Perhaps, Tim, any thoughts on how you are using performance metrics and whether 2020 marked a change or steady as she goes?
Yeah, for us, the interesting thing at Intact is that our long-term incentive plan is based on relative ROE, relative return on equity. And so that allows it to stand the test of time. We didn't make any adjustments over the year. The insurance industry as a whole can go through good times and bad based on the frequency of floods and fires and other catastrophes. But the way our plan works, what really matters is that through good times and bad, you outperform your competition. And that's what our LTIP plan rewards, relative ROE outperformance.
It's interesting, in the struggle to find that right balance between the right metrics that are, first of all, good for the company, good for the employees to create that alignment, but also attuned to what investors are looking for. We know full well that investors like to see relative metrics. And but they're hard because in Canada, there's some industries where a relative metric is relatively easy to do from a price point of view, mining sector, gold sector, a few other sectors. But then you get into, well, what other relative metrics can you use? So we can come back and talk about that later, but it's clear that it's working for Intact. Okay. Let's now look at a relatively unique example, just to point out a company that has done something a bit different. So CCL is a company that uses PSUs and RSUs. They actually have parked recently the use of stock options. But what's a little different here is that CCL uses PSUs and RSUs issued from Treasury. And that's uncommon. Most companies use a notional PSU or RSU that doesn't necessarily include having to issue them from Treasury. They can either just satisfy with cash or buy the shares in the market. But the CCL actually issues them from Treasury. Now, why does that matter? From a tax point of view, that allows the term of these instruments to be longer than 3 years. You can make them 4 years, you can make them 5 years, you can make them 7 years. There's no actual prescribed rule. And we bring it to light because having that flexibility to make the term of these awards longer, in fact, CCL took advantage of that, and their operations were also disrupted last year. They had an existing grant of PSUs made 2 well, at the time, 3 years ago. And instead of just cashing them in at the time, they said, we're going to extend the period of maturity 2 years, and we're going to still hold the performance features in place. But they had that flexibility to do so. So it was very interesting. We bring it up for the audience because people ask, what creative solutions are people using out there that go beyond the usual tools? And here's an example, not used very often because a lot of companies don't have the appetite to think about instruments are this long, but it's just another tool in the toolkit beyond just stock options. So if we go now to one more slide forward, we're going to review the polling results. Thank you to those who participated before this webinar. You took the time to do that. That's very helpful. And what you'll see here is that turning our attention to 21, we wanted to know what changes were in mind during 21. And what we see here is that over 40% of respondents were saying that they were going to be having to look at their annual scorecard with some kind of change to the formula or the framework of some sort. About a quarter of the companies were going to look at the change in mix for the C-suite. Not too many were going to adopt different types of instruments, so no surprise that that number is low. Not too many people changing the peer group of their overall compensation. So these were quite consistent with the poll that we did in the fall. And essentially, it's not surprising to see that during 21 or for 21, the repercussions of COVID were still being felt and people needing to do some adaptation. So I'm going to now turn it over to Scott to talk about Say on Pay.
You're muted, Scott.
Thank you. Sorry, I didn't realize I was muted. Pardon me, folks. It's now an official Zoom call. Apologies for that. This past year was an interesting one. So we saw a few different outcomes coming from this year's Say on Pay, and these numbers were really just updated this morning, so fairly hot off the press. The first would be really a more negative year, or a year of lower shareholder support. So probably not a surprise to folks given some of the stock market returns that George was speaking to earlier. And given some of the challenges that organizations had in terms of trying to come to an answer around how to attract and retain executives in a fairly dynamic operating market, stock market, and at the same time come up with a compelling message to shareholders that aligns compensation with performance. And that created some, for lack of a better way of putting it, noise. So you see in this chart a general shift. Some folks that were over 90% last year moved to the 80 to 90% range. Folks that were a bit higher moved to the 50 to 70% support, or less than 70% support. And so another key theme would be a bit of a barbell distribution. Companies were either fine and actually had a fairly strong Say on Pay result, or they were getting more scrutiny, and it resulted in either a failed outcome or a low outcome. If we think about for a second, industry by industry, just on the next slide, we'll see a couple of interesting answers, and these two align with the stock price charts that I think George shared earlier. So materials ticked up, energy ticked down, financials came down as well, albeit from a relatively high level for the financials. If you are wondering a bit about the US and the US numbers, generally speaking, Say on Pay has been more conservative in the results this year compared to last year, so a higher proportion of negative results. In fact, one number that really kind of caught me, not by surprise, but it was just surprising in its magnitude, is about 7% of the US energy companies in the S&P 500 failed Say on Pay. So a fairly high proportion. Now, granted, in an industry is one of the industries that really suffered quite a bit last year, due not just to COVID, but also to some oil price wars that were going on at around the same time in the second quarter. Notably, just on the US side again, there's been some fairly high profile failures. So an indication that some degree of shareholder activism that's getting traction and some support from some of the very large institutions like State Street and BlackRock. And so just some examples off the top of my head: AT&T, Intel, IBM, Starbucks, Walgreens, all had say on pay results this year that were below 50%. So maybe I'll pass it over to Jennifer and Tim now. Jennifer, I know Baytex went through a lower say on pay outcome a couple of years ago. Can you kind of comment on how that plays into the board's thinking around compensation and disclosure at this time?
Sure. In 2018, Baytex received a score of 75% on say on pay. So it's a topic that remains relevant and topical for us. And we're consistently thinking about executive pay and the shareholder experience. And unfortunately, we ended the year at a stock price of 69 cents, and we've since recovered to over $2. But in the context of the lower stock price, what the board decided to do was to cap the multiplier on the LTIP award. Typically, it has a multiplier of 2, but given the year we had and the stock price where it was, we capped it at 1.5 for the award made this year.
So that has, you commented earlier that by delaying it, it had the effect of lowering dilution. And of course, capping the multiplier also would be a way of mitigating dilution.
Correct.
Now, in the context of a stock that had a fairly high beta and maybe some room to run. So
Exactly.
a bit of an interesting compromise there. Tim, your perspective on say on pay, why boards pay attention to it, maybe how it gets interpreted by boards from time to time.
Well, I just say, even if you get a high score, it really matters to boards. It provides shareholder reaction to compensation plans, but just remember, it's a really blunt instrument. And so a low score may be a comment about your compensation plans, but it can also be something else that they dislike about the way the board is handling things. It's just a general statement of frustration. And I think it can be an early warning system of a vulnerability of some sort. And then it's incumbent upon the board to penetrate more deeply and figure out what is it that they don't like. We know they're unhappy. We just got to figure out what it is.
Yeah, I can think of a few cases where the say on pay outcome, by the time the boards went out and did engagement, actually tracked back to strategy, leadership, maybe 2 or 3 things that, as you say, it's a blunt instrument, but it's one of the only instruments that shareholders have to express some degree of concern. And it's frankly, a lower threshold than voting against the directors themselves, right?
Yeah.
And so I remember it used to be that, and I think that you still see this to some degree, some of the large institutions would start by, let's have a conversation. And if that didn't get them anywhere, the next year it might be, here's a letter. And if the letter wasn't really responded to by the company, then it would move to, let's talk about how we're going to vote our shares on say on pay. So a little bit of a step process to try to communicate to the board. Let's go on to an example of an organization, a company that tried to make some changes this year, and at the end of the day did not receive shareholder support. But it's an interesting case because there's a few different moving parts here. So in the midst of COVID, from the proxy, we gather that Gildan really was trying to look at how did their business strategy change and how did the performance measures that they had put in place remain relevant. And so they made a few changes. First of all, they looked at, did the performance goals they put in earlier in 2020 still match with the business plan? And they came to the conclusion that it didn't. So they had a question around, should we look at changing those metrics? The second piece they did that was, and I'm reading between the lines here a bit, but it seems as though they said, well, if we're changing the metrics, we should change the leverage on the STIP program for 2020. So a bit of a mirroring there, right? So if the business plan didn't have as much upside, then the STIP maybe shouldn't have that upside either. So they lowered the cap for 2020 from 200% to 100%. Now, then they started looking at how do we create the alignment that they want. And so they did a couple things. They put in some premium priced options for the CEO. So these are options that require the stock price to go up before the options vest. So it's not merely a passage of time, but also a performance criteria. And they attached performance criteria to the LTIP awards for 2 other executives. So these were performance vested one-time grants that went to these 3 executives. Now, I think in looking through it, shareholders saw all that effort to create alignment, but they also saw a meaningful increase in executive pay and CEO pay in particular. And they saw a discretionary award in the STIP that went to that new maximum of 100%, resulting in the outcome that the shareholders voted on a few weeks ago. So it does highlight the challenges of balancing what's right for the organization, how's the market and the metrics moving, and how do we explain all of this to shareholders, which is the awkward spot that directors found themselves in last year. George, I'm going to pass it back to you to talk about stock options.
Great, thank you, Scott. So on the next page, we give you a little summary of what's happening in Canada. And let me give you a few facts that most of you might be already aware, but there is a lot of confusion here. Let me try to make it as simple as possible. The rules as of July the 1st are happening. So this has been punted for several years, but it's now actually going to happen. And what's happening? In fact, for certain companies, and I'll get into which ones in a moment, but for certain companies, especially large ones, the taxation of stock options when employees realize a gain is going to double. Under the old system, that taxation was essentially a capital gains like rate, so very attractive, around 25% taxation rate. And going forward, that's going to be the full taxation rate at the marginal rate of around 50%. At the same time, the corporation is going to get a deduction. Now, before, under the old program, corporations did not have a tax deduction. So there's a bit of symmetry going on where the employee is actually going to be worse off. The corporation will be better off. The shareholders will be better off. It's not completely tax neutral to the government, but this is not actually a grab by the government of tax dollars. And it really was, in essence, the government's policy of trying to put more taxation on the higher income individuals. This applies, to be clear, to publicly traded companies that are large, that have at least $500 million in revenue. If you are a Canadian controlled private company, this does not apply. If you're publicly traded and you're under $500 million, this does not apply. So that's good news. There are other complications. If it does apply to you, around the first 200,000 being exempt from these rules. So lots of details to pay attention to. But question back to Jennifer and Tim, how, if at all, are these changes factoring into your use of options?
So maybe I'll start, George. Baytex removed options from their compensation program a couple of years ago, and Franco-Nevada removed the stock options from the LTIP program this year. And their vesting was only time-based, and it was replaced with a higher target percentage of PSUs. And for the first time, they added a multiplier to the PSUs, which was a common feature of their peer group.
Interesting. And Tim, how about you?
We haven't made any changes based on this change to the taxation policy. At Intact, in fact, we've just introduced a stock option plan to support the transaction of an acquisition of Royal Sun Alliance Insurance in the UK. And at Hugessen, its IPO was only 4 years ago. This is a company that's still growing very rapidly in the early stages of its public life. And so it's sort of like a tech startup in that sense. So we are not pausing our stock option plan just because of the tax change. We're forging ahead. This has been an important part of our comp plans for years, and we're keeping it that way.
Got it. And, you know, thank you. We're going to show the results of a poll that we did, again, right before this session today, and we got some good results. And what it does show and there's no surprise to us because of all the conversations we're having with our clients, but almost 60% of those who do use options are expecting to continue to use them. And of those, however, they are thinking about how they might reduce the proportion of options as part of the total long-term incentive program. If we have time at the end, we might come back and share some insights on how people are thinking about that. But let's maybe move on, Scott, over to you on the ESG topic.
Thanks again, George. So we did a look through the proxies this year and tried to gather some information about the use of ESG metrics. And I should be clear here, this is in the context of incentive programs for organizations. And so the big picture finding, which is the bottom line that you see here, is that the total number of companies with ESG metrics, actually, it's now 62% of organizations in the TSX 60 within the have them within the short-term incentive plan, and 17% have them within the long-term incentive plan. So a fairly wide-ranging use. The other sort of finding is that the measures cover what I would think of as being the sustainability focused measures, as well as some operational focused measures. So we see on the sustainability side, D&I, environment, brand, and CSR. And on the operational side, we see employee metrics, customer metrics. So it covers really both spectrums. On the next slide, we've just highlighted 3 organizations that have first of all, disclosed a measure this year within their plan. And some of these are interesting cases that I just thought I'd pause on for a second. So TELUS Corporation applies a 15% weighting on their social capitalism measure, which is really a commitment to community brand perception and also greenhouse gas emissions. Cameco has a 15% supportive communities weights in their short-term incentive plan scorecard, and it focuses on boosting local markets and source services from Northern Saskatchewan vendors. And Suncor has a 5% weighting on sustainability. Now, they've had a long-term, fairly effective sustainability reporting program at Suncor. And so one of my comments here is there's an element of moving weighting onto ESG-like measures within the shorter long-term incentive plan. There's also an element of codifying and in some ways incentivizing some practices that have been in place at the organizations for a long time. So Suncor's been reporting on sustainability for a couple of decades. And the difference, I believe, is the addition of the new Chief Sustainability Officer. Cameco has actually had a supportive communities measure within their plans and within their operations for also a number of years. So it's bringing to prominence some of the ways in which these organizations have been communicating with their employees and outsiders for a long period of time. So maybe with that, we could start the Q&A. And oh, pardon me, sorry, we have a poll I got to go through here first. So we asked folks that registered for today about the degree to which their plans incorporate ESG measures, and 31% yes. We then asked, to what degree do you expect the emphasis to change? And 54% said we don't really see a change happening. But 24% thought that the change would happen in the short-term incentive plan, and 22% saw it happening within the long-term incentive plan.
Maybe Tim and Jennifer want to comment on what they've been seeing with their companies.
Well, I can start. Maybe I'll take the ESG in reverse order. The G there's been lots of emphasis for years on governance, strong desire by boards to adopt best practice and to move up the league tables on scorecards like the Globe and Mail board games. On the S, there's also been a lot of focus, and we include in both companies measurements in the STIP plan relating to employee engagement, lots of emphasis there. A lot of emphasis also and STIP measurement systems on diversity, equity, and inclusion. Both companies are signatories to the Black North Pledge, and so they've made a commitment to make significant progress in this area. And lots of emphasis as a result inside the company on developing affinity groups and supporting diversity within the company. On the environment side, the E, it's grown very, very rapidly in importance, and there's progress being demanded by consumers and by government and by shareholders, but also by employees themselves. They want to see progress. And we need to make sure as we introduce measurement systems that we keep all of these various measurement systems in balance with one another. We don't send our management team off in a completely new direction and ignore the old measurements. And so that balance, that harmony between all the measures is important. In our case, in the banking and insurance business, the regulator has even started to talk about imposing new measurements and rules on us, which, well, we'll wait to see what those measurements are. But it's a bit scary, to be honest, as an outside force imposes new environmental regulations on an industry that has a very small greenhouse gas emission footprint. So we'll see what the impact of that is.
I'll go next. At Franco-Nevada, ESG is one of its 5 corporate goals. So it follows that it's then also a comp goal program. And we look at 5 pillars of ESG, including such things as diversity, ESG reporting, ESG ranking, to name a few. And if I compare that, Baytex has been traditionally focused on health and safety, but in the last few years, they've increased the emphasis on the E, adding goals on the scorecard in terms of GHG emission reductions, as well as asset retirement cleanup goals. I do think ESG goals and reporting could benefit from a streamline in the standards. You know, out there you have SASB, you have TCFD, and you have other standards being proposed. And it's a lot for the companies to work their way through and to report under all these different standards. So I think the industries and I think the shareholders and everybody could benefit from an alignment in terms of which standards we should use going forward, and hopefully only one set of standards.
Maybe a question that's come in that is just on topic here. So Tim, Jennifer, if you don't mind me putting into the mix now as opposed to in the Q&A segment, is this question about what measures would you put in as a long-term measure on ESG? And do you see ESG measures as being better in the short term or the long term? So I don't know if either one of you wants to start.
I think it can fit in either one. I am most familiar with using it as part of STIP plans. Perhaps as we introduce more measurements in the environment area, these things take time. You know, it's a long-term impact, and maybe that would fit more nicely into LTIP rather than STIP. I think as long as you're measuring it and as long as you're rewarding it, how you go about that, it doesn't seem to matter so much to me. But that's just me. Jennifer, what do you think?
I would say it should probably be in both. I think, you know, there's a short-term focus and a long-term focus. And I think some goals are better, you know, in terms of ESG goals are better suited to the short term, others to the long term. Like if you think about a diversity goal, you don't want to change your whole executive team to get better diversity in 12 months and lose that continuity and retention, right? So, you know, if you set a goal kind of in 2 or 3 years of this is where you want to be, perhaps it's more of an LTIP. And similar in terms of some of your, if you're thinking in energy and GHG reductions, like those take investment, they take time. So some of those goals, you know, you might have an annual target, but you also might then have a 3 or 5 year target that you're measuring as well.
Great. I'll plug the folks listening again, just to send in your questions. We do have a few that have arrived in, so we'll get to those in a couple of minutes. We have, I think, really one last slide that's more of a summary slide before we move into the Q&A segment. So really, where do we, what do we see as the future implications for all of this, having considered the disclosure this year and the impacts of COVID and where the markets are heading? So one would be a continued link between pay and performance. And I think, as was mentioned earlier, we see these relatively stable looking disclosures regarding executive compensation and CEO compensation year over year. And those, it's important to point out, those are average and median numbers. When you actually lift the hood and you look across the TSX 60, you see a degree of variation, both in terms of the disclosed grant date values, and you definitely see a lot of variation in terms of the realized pay analysis that occurs, and that doesn't get disclosed as effectively as the granted compensation levels. And so company-specific fact patterns are going to create a certain degree of variation in pay and a higher alignment of pay and performance. The second is going to be this: we expect decreased use of stock options in substitution for PSUs and RSUs. We don't think stock options are going to go away, but we think the new tax environment that starts July 1st is going to put us into an environment that's more analogous to the US. And so we would expect to see a transition that's not much different than what we see in the US at this point in time. The third would be this incorporation of ESG measures in the STIP and the LTIP. And then what I would say would be enhanced disclosure and communication around ESG, but also diversity and inclusion measures. And that alignment between pay, culture, strategy, and the strategies related to those two items in particular. So with that, I don't know, George, is there a question in particular you want us to start with, or do you want me to go through the list?
Well, there's a couple that came up that are tied to the last topic on ESG, maybe, that we can look at. And one of them dealt with, how are boards dealing with income inequality? Another question had to do with, how meaningful are these ESG metrics? Is it really going to make an impact, or is it more just a signaling tool? So maybe I'll offer a couple of thoughts and then invite Tim or Jennifer to weigh in. In terms of income inequality, what we can share as an advisor to many companies is that it is on the minds of boards, it's on the minds of management teams. And especially this past year, when boards had to decide what, if anything, they were going to do to potentially support compensation when programs were blown out of the water. And what they did do, I can tell you, is that they first looked in priority at what was the employee experience before they looked at the executive experience. And when they were trying to exercise any kind of discretion, they made sure that in proportion, the employees got a better outcome than what an executive might get, just because of that's where the focus needed to be. So it's a bit blunt, but it was very clear that the right thing to do was to first look at employees versus executives, because the executives get compensated another way. Another point on this issue: companies individually care. The members of the board care about income inequality. It's a flashpoint. The nervousness around what they can do around how do we set pay lower? Are we going to be the company that sets pay lower to send a signal? You might want to, if your pay you think is too high, but at the end of the day, if you start to be the leader in your field of setting pay lower, what signal is that sending to your own employees, and what are you doing from a competitive point of view? So it's very challenging for a single company to be an outlier in that area. But again, curious to know, Jennifer or Tim, if and how you've dealt with this issue this past year.
I think you covered it off well, George. I think, it is true, as you're thinking about the decisions and the impacts in the last year, that I think boards really tried to focus, as you said, on the employee outcome.
I agree completely. And I also agree that while income inequality is on the board's mind, retention of key talent and is also on their mind, and being able to put their hand on their heart and say we are paying competitively relative to the marketplace. I think that's also top of mind.
Right. And this is, I'm going to talk about Air Canada here for a moment because it was a flashpoint in the last few weeks. And just, I mean, it was in the news, so most people probably are aware, but let me just give a few facts just to level set. But in the Air Canada case, we know that the company historically has been a very strong operating company, but obviously, like many airlines, they crashed in terms of their operating performance in 2021. And in response to that, they took dramatic actions. I mean, the most notable is that their employee base was cut by tens of thousands in response to just no demand and restrictions on flying. They had to raise $8 billion in private capital. They did all kinds of other things to ensure the safety of passengers and employees. They tell a very compelling story. And on the compensation front, what they did is their short-term incentive program, first of all, there were salary cutbacks that occurred at every level among the senior team for a while. Then the short-term incentive program was going to pay a zero. And what they decided to do at the end of the year is actually award a special. So they let it be zero, but on the other hand, they put on the table about 40 cents on the dollar of what target bonuses would have been. And they put that, so that was a special bonus that they put on the table. That's what garnered a lot of negative attention. And then in their LTIPs, there were 3 years worth of LTIPs that are outstanding. The performance piece of those were all going to be zero for several years to come because of the way that they're structured, and they made some adjustments. So there was a backlash, especially around the bonus, that occurred amongst many stakeholders across Canada. And it's a highly competent board. And a lot of these decisions around pay were made before the company took any money from the government. But, Tim or Jennifer, you can't revisit how things were done, but any thoughts on how to make some sense of that situation?
Well, I think the lesson to anybody that's on a board is anytime you take taxpayer money, all the rules that you've operated by go out the window. If you're taking taxpayer money, you are inviting the opportunity for a reporter or a member of parliament during question period to absolutely pillory you. And so you have to go in with that mindset, knowing we will be attacked for anything that we do because now we're using taxpayer dollars to shore up our company. And so whether their pay structure was right or wrong, I think there was perhaps, they should have known that this was coming, because anybody that takes that many taxpayer dollars is going to be pilloried in the press.
I don't disagree with anything Tim said. I just would emphasize, I think it's an incredibly hard decision for the board to make.
I agree.
And, obviously one of their concerns would have been retention of key staff. The airline industry competes globally for key talent. And I don't have enough about knowledge to know what competitors did in the industry, but I'm sure one of the things top of their mind was having to retain staff so you have the skills and resources you need for the recovery.
Very tough, very tough. And by the way, ISS and Glass Lewis have each issued their reports. They are now in favor of the say on pay. They quote a few things, but they do, ISS did take note that management has decided to return the bonuses, but they took a holistic view and are recommending to their clients, the shareholders, that the say on pay should be approved. So it's an interesting story. So it may be relatively unique, but it's one that highlights the tough decisions this past year, how timing matters, what did you know when, et cetera, et cetera. Very, very tough. So Scott, back to you. I think we may have some other questions that have come in.
We have a lot of questions that have come in, and they're good ones. So I'll throw this out to the three of you. I'm just trying to figure out the best way of summarizing it. Okay, It's becoming more and more accepted that company value lies in strategic value enhancing resources it holds rather than traditional accounting measures. So intangibles like patents, brands, tech systems, human capital. How are compensation systems evolving to adapt to those intangibles? I don't know if anybody wants to go first.
Well, I think that generally compensation systems are meant to reward value added.
Yeah.
And so the people who are building the brand, the people who are building human capital, the people who are garnering patents, these are the people who it's provided we've got the right measurement systems internally to measure those things. Those are the people who are most richly rewarded. So it's maybe I'm not getting at the essence of the question, but I think those intangibles are very much valued by companies, measured by companies, and that's how the performance and reward systems work, and how performance review process works inside of most companies. Jennifer?
Yeah. Jennifer, anything to add?
No.
No. Tim, I agree. I think where it comes through is if these intangibles have meaningful market value, it's going to be reflected in the equity value of the organization and come through in the long-term incentive plans, which, you know, most public company compensation systems for the executives is geared towards the long-term incentive. And so you end up with that degree of alignment. That'd be my short-term view.
I will say though that the question itself has embedded, you know, I think a very thoughtful reflection of, you know, like, what's important, and are we aligning people's pay with what's important, not just financial outcomes. So that theory is getting more momentum, and so what we've seen at the margin, you see it in scorecards, is that a fraction of the scorecard is being carved out away from typical financial metrics, whether it's simply EPS growth or EBITDA margin or return on capital, whatever financial metric, and you're seeing some fraction, 15, 20, 25% tied to a basket of strategic goals. Now what are those, or what are the KPIs? But that's unique to each company, but that is addressing in part this question that people want to align on things that go to the how. How did we get to where we want to get, or what are the important building blocks, whether it's innovation, new product development, things like that. Those are starting to appear in scorecards. Now, the uncomfortable part is, how do you measure that fairly? How do you score it? That's a challenge, but some companies are willing to do that. And is it a big trend? We'll see, but it's a direction that we are observing.
Maybe I would just add that, you know, when I look at the resource companies I'm involved with, all their comp programs would look at resource replacement, which is key, right, to their future, not a traditional financial metric, but they would both have in their LTIP programs measures on resource replacement and resource growth. So.
I think we have time for one more question, and I'll take the last one to come in. And I think it relates to the change in the stock option taxation. The question is, what's the new long term? Given that we tend to be tied to these 3-year plans. I don't know, George, do you have a view on that one?
I think it's a challenge that, you know, in the private sector, so non-publicly traded companies in the private sector, which is massive, companies are able to actually align outcomes over the long term. You look at the private equity-backed companies, they align management teams over a decade or whatever it takes until there's, and it's that trying to replicate that long-termism is hard. And you've had shareholder groups led by CPPIB and others globally trying to really encourage long-termism. The problem is that the tools exist. Stock options aren't going away. They exist. They are still long-term. And for many companies, stock options are going to be quite, for many large companies that are negatively affected through this taxation, stock options may still be the right trick. I would say that the tools that I mentioned earlier around treasury issued shares that you can attach performance conditions. You can make those 5 years or 7 years or 8 years. You should investigate a little more about that if you've never heard of this thing, but you should look at it and test to see, could that tool work at our company? That's not new technology. It exists, but maybe these changes are going to force people to think about these things.
Thanks, George. I think we need to bring this to a conclusion. So ladies and gentlemen, we've come to the end of our time. Thank you. Jennifer, Tim, George, thank you very much for your participation today. Lori and Salam, always a pleasure to partner with you guys. And the authors for the Hugessen materials today were Matt and Sham. So thank you very much, guys, for pulling that together. We enjoyed today's session. As I mentioned earlier, the slides will be available on the ICD website within about 24 hours. For those of you that submitted questions, we'll do our best to get an answer back to you. If you have any questions about evolving compensation trends, please check out the Hugessen website where you can find sort of our thought capital section that will have the information there for you. On behalf of the ICD, Hugessen, Tim and Jennifer, thank you very much for joining us today.
Take care, everybody. Thank you, Tim. Thank you, Jennifer. Thank you, everybody.